This is Jody Trana with Chapter 14, Part 2 of Business Finance. Because companies have multiple sources of capital through debt and equity, we think of the cost of capital for a company as the weighted average of all the required returns of the people, the investors who are holding on to our debt and our equity. This is the firm's weighted average cost of capital. It incorporates the cost of debt and the cost of equity. Let's review how we determine these amounts. We start out by looking at the cost of our debt. Here we have the cost of debt is 6%, but if we're in the 30% tax bracket, we can reduce our amount of cost of debt by the amount that we save in our taxes. So the cost of debt after tax is 4.2%. The cost of equity is 15%. Now that we've determined our cost of debt and our cost of equity, we're going to look at our capital structure. Of this debt that costs us 4.2%, that only applies to 25% of our total capital structure, because 25% of our capital structure is debt. The other 75% of our capital structure is covered through equity. So the cost of equity at 15% is going to be covering that 75% of equity that we're holding in our capital structure. We multiply the cost of debt, that 4.2%, times our percentage of debt at 25%, to come up with our weighted cost of debt, this is after taxes, of 1.05%. The cost of equity at 15%, we'll multiply that times our total equity in our capital structure of 75%, and that is a weighted cost of equity of 11.25%. One important thing to note is that when we are determining our cost of debt and our cost of equity, we need to make sure that we are using the amounts based on market prices. The same with determining our weights, such as debt 25% and equity 75%. We want to determine these weights based on market prices. We have been using the weighted average cost of capital to determine our discount rate for investment projects. But there are other ways that people use the weighted average cost of capital. You can use it to value a firm, and you can also use it to evaluate performance. The cost of capital varies across firms because of differences in their line of business. In some industries have higher weighted average cost of capital than other industries, but also the way that the companies choose to do business. It can help to determine a little bit of the business risk, and it also shows the differences in the individual capital structures, or another way to talk about that is their financial leverage. And a leverage that a company has, how much they have out in debt, is really a source of financial risk. So here is a table that shows estimates of weighted average cost of capital for just a few large U.S. firms. You can see that the weighted average cost of capitals range from 3.31% to 7.2%. In general, the firms with the highest costs of capital are those with the lowest use of debt financing. Let's review the three-step process in estimating a firm's weighted average cost of capital. First, you define the firm's capital structure. Second, you estimate the cost of each source of financing. And third, you calculate a weighted average cost of capital from all sources of financing. When we define the firm's capital structure, we look at the market value of all common stock outstanding, preferred stock outstanding, and bonds. This is how much we could sell these for today. That helps us determine our true capital structure and not just the amount that we have on the books. We want to convert those market values of our different capital structure items into percentages so that we can see the percentage of our different capital items. Here you can see common stock is 50%, preferred stock is 17%, and bonds are 33%. Using the processes we have learned in previous chapters, we'll calculate our cost of bonds, of preferred stock, and of common stock. We need to make sure to adjust our after-tax costs for bonds, and then each one of these amounts in the column D will be multiplied times our capital structure weight in column B to identify our weighted average after-tax cost of capital.